What is up, everybody? Welcome back to another episode from Coin and Capital. It's Chris, and here we talk about macro, finance, crypto, Bitcoin, bonds, whatever it may be that is bringing headlines. We talk about it, break it down, try and find some truth behind it. And today, guys, wow, what a week. What a week we have had in the bond market. What a week we've had in crypto and in equities. And I'm here this Sunday to talk about it. Okay, we're going to look at Japan, how Japan blew up and margin called the whole world. We're going to look a little bit behind the scenes at some liquidity and how that's affecting Bitcoin and the overall market. Stick around. Let's get right into it. Kicking things off, the great repricing. And no, I'm not talking about Bitcoin. I'm not talking about your favorite stock ticker. I'm talking about the Japanese 10-year. Okay, so over the last, especially the last 2 weeks, we have seen the Japanese 10-year explode up. Okay, the Japanese they're doing something. They're doing something over there. But the thing we need to understand about Japan and where it fits in the puzzle of global economics was that for so long, Japan had essentially no yield, right? Zero carry. The Japanese yield on the 10-year was like sub 1%, meaning the rest of the world could go borrow in yen and then go buy NVIDIA, right? S&P 500. Go make returns there, right? So you're borrowing for zero essentially, and then you're making 10%. Pretty good trade if you ask me. So what happens when the Japanese 10-year all of a sudden moonshots? Well, the whole world gets margin called, right? Because they lever up so much in these carry trades that eventually when the yield spikes like it did, it's now sitting pretty damn close to 2%. That means all these people running the carry trade have to delever, right, to cover cost, because now funding this trade is more expensive than they thought, right? They either have to post more collateral, delever, and fund more capital to preserve the trade, or they just exit the trade entirely, unwind the whole thing, and call it quits, go find it somewhere else, okay? Now, this has sent ripples through the rest of the world, right? Bit of a repricing has gone on in bonds, causing a global risk-off sentiment, okay? So the thing we also need to understand about bonds is they price risk in countries, right? Japan, bonds, price risk in Japan, Canada, US, such and such, okay? So when Japan spikes, people are pricing more risk in Japan. When things like the Canadian 10-year and then the US 10-year spike as well, alongside Japan's spike, right? People are pricing more risk everywhere else, okay? Why? Because Japan was such a big source of funding trades around the world. When that funding gets squeezed, okay, investors are, they get scared. Hence the big risk-off repricing. Okay, we saw the Canadian 10-year shoot to like 3.4%. And then we have the US 10-year trying its hardest to spike amidst this Treasury buyback program. Okay? So in terms of risk assets, equities, crypto, Bitcoin, this global repricing in the bond market this week has acted as a near-term headwind. Okay? So places like the States, Canada are running a yield curve light control, right? So the Treasury's having these buybacks, Canada's doing its own thing, right? So there are active measures already to try and suppress yields, meaning moving forward, if we would like to see that headwind diminish and completely cease to exist, we really want to see the 10-year yields roll over to the downside smoothly, okay, or abruptly. That would be nice too. But Why would we like to see that? Because that means the liquidity is being added to smooth this over. Okay, bringing us to the next slide. The only thing left to do is to print. Okay, so context for this global macroeconomic puzzle, especially in the West, all of our nations are severely indebted. Okay, due to the nature of our monetary system being no longer pegged to gold and to the laws of Mother Nature, countries are allowed to run budget deficits to infinity. Okay, they're allowed to spend as much money as possible because we can just make it out of thin air. Okay, that also means that they have unlimited power to control markets through this yield curve mechanism, right? So say you have a country like the US, $37 trillion in debt, right? And a good chunk of that is financed on the long end. And then Japan decides to margin call the world, okay? If you're the US, your long end financing just ticked up 0.5% to 1%, okay? $37 trillion, that gets very expensive, right? So they need this yield curve control to smooth things over, to keep the financing costs low, right? And they do that by printing money. To print money means excess liquidity in the system, okay? And one of the best proxies for liquidity that you and me as retail people have access to is the US dollar index, DXY, okay? When the DXY is below 100, 99, 98 even, very positive, right? If you've been following this channel for like the last month, 2 months, we've been tracking the DXY movements. So the recent uptick went from a tailwind into a headwind, okay, as the DXY pushed above 100. Now the DXY pushing down to 98 and below, we have targets at 95. Means that that headwind is now turning to a tailwind, meaning very beneficial for risk assets. However, that dichotomy between the tug of war we've also been discussing, right, between the DXY spiking, yields coming lower, now it's the opposite. The DXY is softening while the yields spike, right? So we have this tug of war happening right now. It's been a while since we've had congruency between the two, okay? I believe that's going to be one of the next big capitulations, is when we have the dollar easing and then yields easing at the same time. I think that's when we're going to start to see a lot of liquidity begin to flow back once this tug of war dynamic ceases to exist, okay? So we want congruency in the market. Investors want very clear signal on when to move. And then as far as front end liquidity goes, right? So we looked at the 10-year, one end of the curve. Now we can look at the very front end, right? So financing for a night instead of 10 years, right? So to look at that, we look at the SOFR rate, and same thing. It prices really, really, really short-term risk, okay? And last week, it spiked, right? Everything kind of puked with that risk-off Japan margin call, including the overnight rate, right? Good thing is, though, the overnight rate has come back down, right? Meaning, in over-indebted systems, when these rates come back down, right, because they want to stay perpetually high, because people are pricing risk on these over-indebted nations, when this rate comes back down, means liquidity was added to smooth the issue over, okay? Meaning, there's probably going to be some liquidity tailwinds coming into the crypto markets and risk as well. Something to watch out for. Crypto specifically, stable coins, right? Stable coins are growing, whole crypto market's growing. If it's not, whole crypto market is contracting. Changes in the last 7 days, plus 2.75 billion, not bad. Changes in the last 30 days, so we're up 6% on the month. Pretty good. Changes in the last 7 days, just over 1%, okay? Stable coins are back growing, meaning liquidity is trailing down into the crypto markets, providing a tailwind for Bitcoin, Ethereum, Solana, and then the rest of your altcoins. From the short end, it's looking pretty good. Okay, overnight rate is down, stable coins increasing. Again, we just need some congruency with the long end of the curve, which I'm sure the treasury buyback programs are going to flatten that out. Okay, yes, it's going to continue, but to really put, I guess, more emphasis onto it, we should look for some headlines on accelerating the program or buying more treasuries in one lot, things of that nature. Final chapter of the video, institutions have not left, guys. Okay, big topic on this new crypto cycle is institutional players are here. Institutional players are running basis trades through these ETFs, meaning a good chunk of them are treating a good chunk of their Bitcoin supply and Ethereum supply as trades. Okay. Good chunk of it though is long-term holding, but a good chunk is trades. Basis trades, they pretty much just profit off a spread. When funding spikes, that spread compresses. Okay. A spread compresses, there's not a lot of room to make profit. Okay. When a spread is like that, right? A lot of room to make profit. Okay. Funding compresses. Trade's not attractive anymore. Institutions are out. Okay. They are profit merchants. They don't care what it is. They just want to make money. Make sense? So they have not left yet. Although Bitcoin, 90,000. Bear with me. ETF flows, not looking the best. But again, we have to understand why. Like I said, these institutions are running basis trades through these ETFs. And right now, all we're seeing is a compression of spread. Okay. Due to these funding costs spiking. However, like we've just discussed, we expect that to totally smooth over in the next few weeks to a month. Okay. Meaning spreads are going to widen again. Institutions are going to come back and these ETF flows are going to tick up and up and up. Finally, it's not a video on this channel if we don't talk about Bitcoin and show the Bitcoin chart. Now, I took this screenshot earlier today. Price has since ticked up. I believe it's 91,000 now, something like that. And what I cannot stress this enough, guys, Bitcoin is a truth machine. One of the only free markets left in the world, and it does an incredible job at sniffing out when liquidity is abundant and when liquidity is scarce in the markets. Okay, and it moves accordingly. Now, why am I saying that? Because, like we just said, front-end funding seems to be smoothed out already. Okay, it's really that long end that's causing issues. But if we know the front end is smoothed out, meaning short-term liquidity has been popped into the system, we expect Bitcoin to sniff that out. Okay, meaning Bitcoin going from 88,000 up to 91 on a Sunday could be something there, guys. Okay. Now, if we put all of this macro confluence together, slap it into some technicals, it looks really good now. Okay, when we start to build some contextualization around everything. So, from the macro standpoint, the DXY is easing. Yes. Treasury buyback programs, we expect those to smooth over the Japan margin call, right? To be dealt with, right? Front-end funding, overnight rates, lowered. Okay, stable coins, growing. Good and good. Pair that with where we are on the technical side of things with Bitcoin. We're at the golden pocket, the Fibonacci retracement, that 78% level. Deep discount of the previous dealing range. Okay. And then the RSI just ticked up from an oversold level. All of this is on the weekly, right? confluence, confluence, confluence. Okay? Start piecing things together. And I don't know about you guys, but all of that seems pretty bullish to me. Okay? And so what can we expect from that? We expect the next 3 to 6 months extremely positive for Bitcoin. If you guys enjoyed this video, drop a comment down below. Let me know what you think. If you have any questions, feel free to ask. I'd be happy to answer. Drop a like as well. Make sure to hit that subscribe button. I'll catch you guys in the next video.